Good afternoon. I'm Todd Piggott, president of ZINC Financial, and ZINC Financial is the manager of the ZINC Income Fund, a mortgage fund with a sub-REIT feature located right here in Fresno, California, where accredited investors can place their money for consistent passive income, all secured by a first position lien on the underlying collateral. Today's webinar will be approximately 15 minutes, and I will highlight many of the benefits for a passive investment in the ZINC Income Fund. Founded in 2006, we've been in business for about 16 years. ZINC Financial is a licensed lender located here in Fresno. We provide loans, business purpose loans, to investors across multiple states who are in the business of buying distressed assets with the intent of rehabilitating those and then reselling them for a profit. We've done close to $1 billion of lending over the last 16 years, and we have a very successful record of returning a very high yield to most of our investors. Our underwriting guidelines are extremely strict. We are not a hard money lender, we're a private money lender. We focus heavily on the condition of the collateral as well as borrower creditworthiness and liquidity. This is our track record over a period of time. Our distribution yield to our investors is approximately 8%. This cash distribution is distributed on a monthly basis, approximately the 20th of each month. This is a debt fund, which means all these loans that are performing within the loan are throwing off cash flow on a monthly basis. That monthly cash flow is immediately distributed to our investors on approximately the 20th of each month through ACH. We've done about 1,400 loans since our inception. We have a long historical track record of positive performing loans in our portfolio. Just close to $1 billion of origination over the last 16 years. It's been very, very successful. And our average loan size is about $350,000. Very granular. That means the fund is spread out among many loans in the portfolio, creating for more consistency of returns as well as mitigation of risk. Our default rate is of less than 3%. And actually, most of those cure. Our actually take-back rate of properties is less than 1/8 of 1%. So we have a very successful track record of performing portfolio loans. 80% of our business is in California. We do have a minor presence in other states across the nation that are favorable both in licensing as well as rates and as well as foreclosure laws. The ZINC Income Fund, we provide monthly cash distributions to our investors every single month. This is done automatically through a third-party servicer located up in Oregon. We mitigate and manage the risk very, very effectively here at ZINC. And we have less than a 1/8 of 1% take back and default rate. And actually, of those properties that we do take back, we rehabilitate those and sell them very quickly in order to recoup our principal back on an expedited basis. One of the founding principles of this is we're very, very careful about protection of principal. That is very important. I am invested in this fund. You are investing alongside me. I get the same treatment as you. And so protection of principal is key in our decisioning here at ZINC. Our fund also provides favorable tax benefits. I will go over those just momentarily. ZINC Income Fund highlights average 8% cash distributions every single month to our investors. The rates to our borrowers, that's the end borrower, they fluctuate between 9 and 12% depending on a variety of competitive decisions or rates out there that are set by the government. So that's approximately our coupon rate to our end borrower that borrows the money in order to fix up the distressed property and obviously resell it to make a profit. Protection of principal, that's very, very important to me. All of our collateral is protected with a first position lien against the underlying asset, where the borrower with an average FICO of 710 has placed their down payment of between 10 and 20%. So we're in an extremely secure position. We have a first position secured lien on that collateral with a prime credit borrower, with a borrower who has contributed 10 to 20% of the actual acquisition cost. Our average LTV in this asset class is about 67%. That means our actual loan to value is about 67% across the whole entire portfolio of loans held within the fund. So we're in what I believe a very, very safe position. Liquidity is available after 12 months in a lockup period. So if you want your money back and you're not happy, you're welcome to get your money back in a period of time. Why is there a 12-month lockup? Well, obviously we took that money and we lent it out in loans. And so that we need to obviously accrete that over time. Mitigation of risk. Our average loan is only 7 to 9 months. This is very important. This is very important because we hedge against market volatility. Whether the market's going up or whether the market's going down doesn't affect us too much because we're in and out of these loans in such a constant and frequent basis. That's one of the reasons I like this segment of real estate investing, is because we hedge against deflation or even appreciation, really, of the underlying collateral. Our portfolio is constantly being refreshed against market conditions. And so since we're into these loans, only about 65 to 70% anyway of their after repaired value, and the loans are only for a duration of approximately 7 to 9 months, we're basically really hedging against market volatility in that. Prime credit borrowers, our average FICO borrowers is above 700. These are good credit-worthy borrowers who have liquidity and have good credit. They simply need the speed and reliability of ZINC as compared to other sources in order to secure that property, fix it, and then resell it to an end user. Our fund's investment is spread across multiple loans. That way, if there is a default or there is a stress point, the mitigation of risk with all of our investors, including myself, is minimized. As I mentioned earlier, I'm invested in this product alongside with you. That means my money is right there with yours. I get no preferential treatment. I'm invested in the same asset class that you are. Distributions are taxed at 80% of the income. This is a very important tax strategy. So the cash that is provided to you we get a 20% tax deduction under the IRS code. So that's very, very beneficial from a tax strategy standpoint. Sort of the Jobs Creation Act, Section 199A, and that's very, very favorable. Also, investors are taxed in the state of residence. So some of our investors located in Texas or Arizona or Nevada that don't have state income tax, that income is taxed at their state that they reside in, even though most of the income might be earned in California. So we have some very, very favorable tax benefits with ZINC Income Fund. Why do borrowers come to ZINC to borrow the money, to buy that property, fix it, and then resell it? Why don't they just go to a bank? Why would a borrower be willing to pay 9 to 12% to ZINC? Number one, speed and reliability. ZINC operates funding their loans in approximately 7 to 10 days. A conventional bank would take 2 months. Number two, federal regulations typically prevent banks from lending on distressed collateral. We've all sold a house and we had to have the smoke alarm or the carbon monoxide detector fixed or the GFI outlet fixed. Banks are conventional that report to the federal government are generally prohibited from loaning on properties that do not meet conventional guidelines. So this provides a real market niche for ZINC because we don't necessarily care about the condition of the collateral. We do care about the borrower because we know that collateral is going to be fixed up and then resold at a much higher price. Longer loan. Banks prefer longer loans. They don't like 7 to 9 month loans. They prefer longer duration loans, and they lack the experience in our market segment. We have a lot of experience in this. We've done a lot of loans in this. We have a real market niche in this, and banks just simply don't have the expertise. Those are several of the reasons why a borrower would not go to a bank and why they would select ZINC for this short-term duration secured loan. ZINC's typical loan characteristics. That's bridge financing for real estate investments. That's right. An investor buys this property. They look to ZINC to fund that loan in typically 7 to 10 days. Their intention is to hold that loan, fix it up to conventional standards, typically in a period of 90 to 120 days, and then sell it to an end user, typically a first-time home buyer, maybe an FHA, VA, USDA, something like that. Geography, we're primarily based in California. Why? Because California is the 4th largest economy in the world, and we're very versed in this state, both from a real estate perspective. California is very desirable. The absorption rate for real estate here is very fast, very desirable. A lot of people want to live here. So that's why we focus heavily on here, but we are in a mild presence in a number of states across the nation. Property types, we primarily lend on single-family residential properties below the median cost of housing. Why? We want to be in houses that are quickly absorbed into the marketplace. And by doing that, we stay in urban settings. We don't do rural. We don't do cabins. We don't do stuff out in the middle of the desert. We focus on typical 3-bedroom, 2-bath, 4-bedroom, 2-bath in well-known communities that's below the median cost of housing, typical single-family residential properties. The borrower, who's that? Typical real estate investor, a broker, a real estate agent, a contractor. They have exposure to real estate investing. Our typical borrower does 4 to 6 of these a year, and they make money like that. Some of them are full-time, some of them are part-time, but they all have good credit. They all have good liquidity. They all put down 10 to 20% against the underlying collateral. But our average borrower is obviously a business purpose borrower, i.e. a contractor looking to fix up the properties and resell them. Loan to value. We typically go to 90% of the acquisition price, not to exceed 75% of the after repaired value. Down payment, all borrowers must put down 10 to 20%, regardless of the equity in the property. Rates and fees, typically around 1 to 1.5 points, maybe 2 points, and our rates range from 9 to 12%. The term of our loans, it's a 9-month loan with up to 190-day extension. And so these loans are very short duration on purpose. We want to be in and out of the collateral relatively quickly to hedge against market conditions out there, volatility. Rehab financing, this is an important part of our loan. We will finance up to 100% of the rehab portion that's held in a control fund, in a trust account, dispersed back to the borrower when that work has been completed and inspected. We only finance the hard costs of the property. Hard costs are physical items that are permanently attached to the property that improve the value. And so this is good that we finance up to 100% of the hard costs. It provides cash flow assistance to the borrower, and also actually guarantees that we know that the funds are there to actually improve the property. So it's kind of like a win-win thing there if we do finance the rehab portion. Typical loan and underwriting, borrower submits a complete application. We get some ancillary supporting documents very quickly. We run credit, we order an appraisal. It moves through processing and then underwriting and then through funding conditions with title and escrow. The entire process takes 7 to 10 days. It's a very, very comprehensive process. Our loan files are typically 3 inches thick. Tremendous amount of underwriting, tremendous amount of due diligence in that process. So we're very, very thorough on our underwriting here to make sure that that portfolio performs over a long period of time. Servicing and portfolio management. I think this is a great question that many of our viewers ask. We are fully in-house here at ZINC. We have about 50 employees here located here in Fresno, California. We do everything cradle to grave. And what do I mean by that? We do pull our own credit reports. We do our own processing. We do our own underwriting. We do our own funding. We do it all right here. We do our own background checks. We do our own insurance tracking. We do our own tax monitoring. We actually do our own loan documents. The only thing we don't do is title and escrow. That's obviously handled by a third party. We do all of our loan servicing here. We make routine contact with the borrowers after the loan is funded, and we do a monthly status inspection reports on our borrowers to make sure that they are actually moving along with the process and that there's no issues that are arising. And if so, we tend to work with the borrowers on that. So we do everything here. We have outsourced that a couple of times over the years. We did not find that to be beneficial. We do everything here because we do it better. And this is my money and your money, and we want to make sure we keep a close eye on it. Risk management, foreclosure proceedings are initiated relatively quickly, typically in about 45 days in the event of a default. That's extremely rare because, again, these are prime borrowers with good credit, good liquidity, and good cash down payment. But it does happen from time to time, and it's usually an ancillary event that happened in the borrower's life that caused them to default. Here's a typical case study. This is a typical distressed property. It's boarded up and some broken windows, and the inside doesn't look all that great. So a borrower would take this property like this and then fix it up to conventional standards, electrical and plumbing and new cabinets, new carpets, new windows, things like this. And then, of course, they would sell it to an end buyer at some point in time. This is a real case study. That's a real property that ZINC actually funded. So how this works is there's the after picture and there's the before picture. You can see the house looks great for an entry-level borrower right now. It's fixed up. It's to conventional standards, and this house will be ultimately sold to an end user, probably with an FHA loan. This might be their first home or maybe their second home, below the median cost of housing for that area. So how this works is we determine the after repaired value, or the borrower does, of that property, and what's the rehab estimate, and then estimated closing and selling costs, and then of course the lender costs, which goes to the origination of the loan, and that goes to ZINC. And then of course there's 6 months, 8 months interest that's paid to ZINC Income Fund for providing the loan and the money as the loan on that collateral. And of course the investor wants to make profit. Our investors earn $25,000, $35,000 per flip. And then of course you get to the maximum purchase price. The borrower must put down some cash alignment down on the property. And of course, we end up with our net loan amount. So it's kind of the strategy of how this loan is kind of structured. They tend to perform very, very well with minimal risk to us. That's how we design this process. Our average loan to value across our portfolio is about 67%. I mentioned that earlier. And so I feel very safe in putting my money in here, passive monthly distribution of cash. This is a typical scenario. Terms of the offering, it's a $50 million loan size. That's where we're trying to get. We have 2 classes of investors. We have Class A. Class A investors are investors who contribute $500,000 or more. Class B investors are investors that put in $100,000 to $500,000. It's an evergreen fund term, and the lockup period is 12 months. How this works is we have a preferred return of 6%. Now, our loans are out there and they're performing at 9 to 12% gross yield. The first 6% goes to the investor. That leaves a few extra percentage points on the table. That's cash. We have a 50 basis point or 0.5% asset management fee that comes to ZINC for us. And then we have a 1% servicing fee that comes to ZINC for servicing out the loan. We do monthly inspections, borrower correspondence, and a lot of tax monitoring, insurance monitoring, and stuff like this. So the preferential rate is 6%, followed by a 50 basis point asset management fee, and then a 1% servicing fee. That takes us to a total of about 7.5%. Obviously, the coupon rate is between 9 and 12. That still leaves some additional cash on the table that's going to be distributed out. That cash is distributed as follows. Class A investors, those who put in $500,000 or more, get 80% of the excess cash distribution. Class B investors who put in 100 to 500,000 get 65% of the excess cash distributions. When it's all said and done, it's approximately 8% that's distributed every single month passively to our investors in the ZINC Income Fund. Again, all unsecured collateral. Professional references. I think this is very, very important. Legal and outside counsel, Jurasi Law down in Irvine. We report to them, or they assist us with all of our legal formalities and things like that. They're a great law firm that does a tremendous amount of private money lender law representation across the country. They are our legal counsel. They watch over us very carefully to make sure that we're doing everything that we should be doing. Our audit firm is Spiegel Accountancy. They're a very large auditing firm for mortgage funds. They operate across the nation, and we report to them. This is a fully audited fund. Finally, fund administrator, Verivest, up there in Oregon, great people. I think they manage approximately 100 funds. They do our compliance and our legal, as well as the accounting monthly basis, and distribute that cash to our investors on a monthly basis. So we have a variety of outside sources that we report to, making sure that we're doing everything we should be doing. We also report to the Securities and Exchange Commission, as well as local and state licensing here. We report to the same licensing entity that most banks and finance companies report to, right here in California. So that concludes our entry-level webinar. If you have additional questions, we'd love to talk with you. I'm Todd Piggott, I'm the president of ZINC Financial. ZINC Financial is the managing member of the ZINC Income Fund. It's a mortgage fund with a sub-REIT. We'd love to have you join us on this expedition. Great returns passively with excellent protection of principal. You can reach us here at Fresno, California. Our phone number here is 559-326-2509. David Sheets is our investor relations person here. He's a great guy, super friendly to work with. David.s@zinc.net. And again, if you have any questions, you can always reach out to me individually. Thank you for joining us today. Have an awesome rest of your week.